Iron trades.
So what does Fibonacci mean in trading? So we're going to talk about how to use it in a real trade, similar to the placement we did in the previous section. Fibonacci levels are used to measure retracements, how far price has pulled back from a previous move, and that can be in either direction. We use them to find where a pullback might stall, where it might bounce, where momentum might shift. The key levels, as we saw in our tool demonstration, the 23.6, the 38.2, the 50, which is not a true fib, but it's a psychological level, the 618, the golden zone, and then the 100, the full retrace. And as you continue in either direction, you'll end up at the 1.618, the 2.618. Those continue on as important levels also. But focusing on the 618, the golden pocket level, if you combine that with structure, with liquidity, or with confirmation tools like the MACD, the volume, the RSI, it becomes a very high quality reaction zone. But again, these levels do not guarantee anything. They just highlight where smart money and large players might act. And that is how we trade the fib, not treating it as an oracle, but as a high quality reaction zone. So why is the Fibonacci important? There's more philosophical here. So if we zoom out, why does it work when we're trading? Well, some people believe that the market moves according to mathematical rules. Some believe that it's just purely algorithmic. Others believe it's very psychological. There's a lot of hype and sentiment that comes into it. And in reality, it's all of these things and more. And the Fibonacci sequence shows up all over nature because it's efficient, it's self-regulating, and it's scalable. And markets are just human behavior at scale. So it makes sense that these patterns appear here too. Now that doesn't mean, as we keep saying, it doesn't mean that the Fibonacci causes price to react. It means that a lot of traders, large institutions, large players, and participants believe in it. And so they act at those levels. And that belief across enough scale in the market, it creates real flow. It becomes self-fulfilling because that's where everyone believes something will happen, so they behave as if it will happen. Thus, it does happen. And that's where the edge comes from when you're using fibs. You're not trading the Fibonacci theory. You're trading everyone else's reaction to that theory. And that is the key difference. So using fibs in trading, here's how we can sort of tie it all together. The actual use case is first, support and resistances. These levels often line up with prior structure, with liquidity sweeps, with unfulfilled imbalances or gaps, and that alignment is really important. It feeds into that psychological level that we were talking about before. Second, entry and exit zones. So fibs help us build a plan. If price pulls back to the 618, the golden pocket, and confirms with XYZ confluences, then I'm going to go long or short. Or I'm partially out near the 38.2 of the previous move because that's often a reaction point, but I'm going to let a runner sit unless it comes back to the 0.5. So any of those fibs can help you scale in, scale out, and develop exit ramp strategies. Third, psychology and volume flow. So these levels are watched by retail, by institutions, by any sort of participants. That means they draw in flow. And that flow is where you want to be positioned just before or just after, because you have the idea and the knowledge that it's going to be a high reaction zone. And finally, in combination with other tools. So we never rely on the Fibonacci alone. Our edge comes from the confluence, using structure, volume, liquidity zones, indicators like the MACD, the RSI, candlestick behavior like what we talked about at the start of this, the fib review. So you think of the Fibonacci as a framework. It gives you a structure to build your steps around. But the trade itself, that's built on how price behaves at those levels, not just the lines themselves. And as we always say, that the levels, nothing is finite in terms of a straight level. They're all zones. So price is likely to behave in and around those levels, not precisely on them, which is why we don't front run moves. We wait until it reacts in a zone, and then we play off the reaction rather than trying to anticipate it. If you try and anticipate a move at a fib level, you are essentially flipping a coin and hoping that you get it right. And the idea of an edge is to develop a much more high probability strategy where it's no longer a coin flip, it's just 85% or higher, this works. And if it's not working, you'll find out very quickly and you can exit. And that's how we bring fibs into our trading strategy.
Iron trades.